Welcome to a comprehensive exploration of decentralized finance, DeFi, where we'll navigate the revolutionary promise, inherent risks, and evolving landscape of this financial frontier. This presentation will equip you with critical understanding to confidently engage with DeFi protocols, identify potential hazards, and glimpse the future of this transformative technology that's reshaping our financial world. Traditional finance has long been dominated by centralized institutions, banks, brokers, and clearinghouses, serving as gatekeepers to financial services. The blockchain revolution introduced an alternative, immutable, transparent ledgers operating peer-to-peer. DeFi represents financial services built on public blockchains, accessible to anyone with an internet connection, without intermediaries. This ecosystem embodies core principles of decentralization, transparency, permissionless access, and censorship resistance. At the heart of DeFi are its core pillars: smart contracts, liquidity pools, lending and borrowing, and decentralized exchanges. Smart contracts are self-executing code on blockchains that automatically enforce agreements, eliminating the need for intermediaries like lawyers or banks for basic functions. Liquidity pools allow crypto assets to be locked in smart contracts by users, facilitating decentralized trading and lending without centralized market makers. Lending and borrowing protocols enable users to earn interest by depositing assets or borrow against their holdings as collateral, all without traditional credit checks. Decentralized exchanges facilitate peer-to-peer trading through automated market makers, where prices are determined by the ratio of assets in liquidity pools rather than order books. DeFi's versatility is showcased through its key use cases: decentralized exchanges, DEXs, lending and borrowing, and yield farming and staking. DEXs like Uniswap and PancakeSwap enable asset swaps without intermediaries, using automated market makers, AMMs, to determine prices based on mathematical formulas and available liquidity rather than traditional order books. Lending platforms like RV and Compound allow users to earn interest by depositing assets and borrow against user-collateralized positions. Yield farming and staking offer strategies for earning rewards by providing liquidity to protocols or securing networks through staking, often across multiple platforms, offering higher annual percentage yields, APYs. DeFi's value proposition is multifaceted, offering financial inclusion, transparency and auditability, efficiency and lower costs, and innovation speed. DeFi protocols are accessible to anyone with a smartphone and internet connection, bypassing traditional banking requirements and serving the unbanked and underbanked populations worldwide. Transparency and auditability are inherent, as all transactions occur on public ledgers, verifiable by anyone. This radical transparency eliminates the information asymmetry prevalent in traditional finance. By removing intermediaries and automating processes through smart contracts, DeFi reduces fees and settlement times for financial transactions. The open-source nature of DeFi fosters rapid development, experimentation, and iteration, creating new financial primitives at an unprecedented pace. DeFi's evolution can be traced through three distinct phases: DeFi 1.0, 2020, 2021, DeFi 2.0, 2021 present, and emerging trends, 2025+. The initial wave focused on basic financial primitives including lending, borrowing, and decentralized exchanges. This period saw the emergence of foundational protocols like Compound, RV, and Uniswap, establishing core infrastructure. The second generation emphasized protocol-owned liquidity, improved tokenomics, and greater capital efficiency. Projects like Olympus DAO and Convex Finance introduced new models for sustainable protocol growth and liquidity management. Emerging trends forecast real-world asset, RWA, tokenization, cross-chain interoperability, AI-powered DeFi services, and increased institutional adoption as traditional finance explores integration with decentralized systems. Price volatility represents one of DeFi's most significant challenges. The underlying crypto assets, ETH, SOL, etc., can experience dramatic price swings, creating cascading effects throughout the ecosystem. For borrowers, volatility poses the risk of liquidation, when collateral value drops below required thresholds, triggering automatic asset sales. For liquidity providers, a unique risk called impermanent loss occurs when the price ratio of deposited tokens changes significantly, causing LPs to lose value compared to simply holding tokens. These volatility-driven risks create a constant environment of uncertainty and stress for DeFi participants, requiring sophisticated risk management strategies and careful position monitoring. Smart contract vulnerabilities have led to some of the largest cryptocurrency thefts in history, with notable incidents like the Ronin bridge hack, Poly network exploit, and Wormhole bridge attack. Private keys compromised, leading to one of the largest cryptocurrency thefts in history. Vulnerability in the cross-chain protocol allowed attacker to redirect funds to their own addresses. Exploited the signature verification vulnerability in the bridge's Guardian smart contracts. Smart contracts' immutable nature means bugs or exploits cannot be easily fixed once deployed. These vulnerabilities include reentrancy attacks, flash loans, drained funds, crippled protocols, and massive user losses with little recourse. Rug pulls represent one of the most psychologically devastating aspects of DeFi. These exit scams occur when developers abandon a project after creating artificial hype, disappearing with investors' funds. Typically, scammers create a new token, pair it with legitimate cryptocurrency in a liquidity pool, attract investors, then drain the liquidity, leaving worthless tokens behind. The human element makes these particularly painful, trust betrayed and financial dreams shattered. Red flags to watch for include unauthorized or closed source code, anonymous teams with no verifiable history, extremely high promised APYs, aggressive marketing with limited substance, and absence of clear roadmap or development milestones. Oracle manipulation and flash loan attacks are sophisticated exploits that pose significant risks in DeFi markets. Attackers borrow millions in uncollateralized funds within a single transaction, requiring no upfront capital. They manipulate price data on DEXs or manipulate Oracle data feeding into other protocols. Exploit takes advantage of the artificial price change to extract profits, keeping the extracted value as profit, all within a single transaction. The Beanstalk protocol suffered a $180 million plus flash loan attack where the attacker used borrowed funds to gain enough governance power to approve a malicious proposal and drain protocol funds, demonstrating how these rapid-fire exploits create chaos in DeFi markets. Despite the decentralized nature of DeFi, centralization risks persist, particularly through front-end attacks, infrastructure dependence, developer control, and governance attacks. Front-end attacks exploit vulnerabilities in user interfaces to redirect funds, even when the underlying smart contracts remain secure. Many DeFi applications still rely on centralized servers, APIs, or cloud services that introduce single points of failure. Developer control is a concern as decentralized projects still have admin keys or upgradable contracts controlled by a small group of developers. Governance attacks occur when centralization of governance tokens allows malicious actors to push through harmful proposals that can drain funds or compromise the protocol. In DeFi, users face the daunting responsibility of self-custody, being solely responsible for their private keys and seed phrases. This paradigm shift from traditional finance creates significant psychological pressures and challenges. Unlike banks, there is no customer support to call if funds are lost or stolen. Common issues include lost seed phrases, phishing attacks, and malware that steals keys. The psychological burden of managing valuable assets without safety nets creates persistent anxiety. Not your keys, not your crypto, highlights the fundamental trade-off in DeFi. Complete financial autonomy comes with complete responsibility. Complex interfaces with steep learning curves lead to costly mistakes, such as sending funds to incorrect addresses, where they become irretrievable. Regulatory uncertainty is a significant challenge for DeFi, with legal gray areas, agency conflicts, accountability questions, and KYC challenges. DeFi operates in regulatory limbo globally, with few jurisdictions having clear frameworks specifically addressing decentralized protocols. In the US, disagreements between the SEC and CFTC over token classification impact DeFi, with debates over whether staking constitutes a security. Regulators struggle to identify responsible parties in DAOs or fully decentralized protocols where governance is distributed among token holders worldwide. The pseudonymous nature of blockchain transactions complicates anti-money laundering and know-your-customer compliance efforts. Regulatory approaches to DeFi vary dramatically across jurisdictions, creating a complex patchwork of compliance requirements for global protocols. The European Union's markets in crypto assets regulation brings stability within member countries under clear rules, with future DeFi-specific provisions under consideration. The United States, regulation by enforcement through SEC lawsuits dominates the landscape, while comprehensive legislation like the Lummis-Gillibrand bill proposes clearer DeFi guidelines. FATF guidelines from the Financial Action Task Force extend the travel rule to virtual asset service providers, with potential implications for DeFi protocols. The push for embedded supervision, or RegTech, within DeFi protocols aims to embed compliance directly into the code, potentially balancing innovation with regulatory needs. Tax compliance in DeFi is fraught with complexity, as every transaction, lending, borrowing, yield farming, liquidity provision, often triggers taxable events under current regulations. Each swap, stake, or claim can be a separate reportable transaction. Many DeFi-specific scenarios lack clear tax guidance. For example, the tax implications of impermanent loss remain ambiguous. Can users claim losses if they aren't technically realized in traditional terms? Users face enormous difficulty tracking and reporting numerous microtransactions across various protocols and blockchains. Traditional tax software is rarely equipped to handle the complexity of DeFi activities. The compliance burden falls heavily on users, with the risk of penalties or interest for unintentional reporting errors in this evolving regulatory environment. DeFi's interconnected nature creates the potential for catastrophic systemic failures. A significant failure in one protocol can trigger a cascade across others, rapidly amplifying the risk throughout the ecosystem. Unlike traditional finance, DeFi lacks circuit breakers or central authorities that can intervene during crises. Once a collapse begins, it can continue unchecked, potentially leading to irreversible losses across multiple platforms. Potential triggers include Oracle failures providing incorrect price data, stablecoin depegging events, major smart contract exploits, widespread liquidation cascades during market crashes, and consensus failures on underlying blockchains. Enhanced security measures are crucial for DeFi sustainability, including smart contract audits, bug bounties, and decentralized insurance. Professional security reviews from firms like CertiK and Consensus Diligence help identify vulnerabilities before deployment. Multiple audits by different firms provide stronger guarantees of security. Bug bounty programs that incentivize ethical hackers to find and report security flaws for rewards. Higher bounties attract more skilled security researchers to scrutinize the code. Decentralized insurance protocols like Nexus Mutual offer coverage for smart contract exploits or validation or slippage, allowing users to hedge against inherent risks in the DeFi ecosystem. Formal verification, mathematical proof of smart contract correctness, represents the gold standard in security but is costly to implement for most projects. User best practices for DeFi safety include doing your own research, DYOR, starting small with new protocols, using hardware wallets, and being wary of unrealistic returns. Never invest based on hype alone. Thoroughly investigate team credentials, anonymous versus doxed, white paper quality, community engagement, security audits, and total value locked (TVL) trends before committing funds. Start small when experimenting with new platforms. Only increase exposure after confirming the protocol functions as expected and has demonstrated security over time. Secure significant holdings with hardware wallets that keep private keys offline. Consider a multi-signature setup for added protection of substantial assets. Extremely high APYs often signal unsustainable tokenomics or potential rug pulls. Remember that exceptional returns are often associated with exceptional risks in DeFi. Balanced regulatory approaches in DeFi focus on consumer protection, regulatory sandboxes, layer-based regulation, and global harmonization. Frameworks that safeguard users from fraud and exploitation without stifling innovation are essential. Controlled environments where DeFi solutions can be tested under limited regulatory oversight before wider deployment. Layer-based regulation allows for centralized on-off ramps and interfaces while allowing core protocols more freedom to innovate in decentralized environments. International coordination on standards to prevent regulatory arbitrage while ensuring consistent protections across jurisdictions. The current DeFi landscape resembles a fragmented archipelago of isolated blockchain islands, each with its own ecosystem, assets, and communities. This fragmentation limits capital efficiency and user experience. Cross-chain bridges attempt to solve this by facilitating asset transfers between networks, but they introduce new risks through centralization and security vulnerabilities, as demonstrated by the Ronin and Wormhole exploits. Layer 0 protocols and app chains like Polkadot and Cosmos are designed for interoperability from the ground up, creating standardized communication between specialized blockchains while maintaining security. The vision of a truly interconnected Web3 ecosystem promises seamless asset transfers, composable applications spanning multiple chains, and unified liquidity across the entire DeFi landscape.